Real estate's a game of OPM.
OPM is in other people's money, right?
That is correct. But now with private credit, it's also old people's money.
Welcome back to the Promote Podcast, your insider guide to the money and mania of the CRE markets. I'm Will Krasny.
And I'm Hiten Simtani. Here's what's on tap this week. Brookfield says mega deals are back, while Blackstone channels Malcolm Gladwell and says we're almost at the tipping point. With institutional LPs feeling less generous, the big money managers are scouring the earth and retirement accounts
In Middle America.
For new sources of capital. We then dive into the singular life of Donald Soffer, developer, visionary.
Yachtsman? Swordsman?
A shout out to our sponsor Vesto, which gives CRE players a single, clear point of access for all their bank accounts. More on them in a bit. Let's start in the inner sanctum of the highest levels of CRE. Brookfield, they deigned to make their new commercial real estate head. His name's Lowell Barron. They made him available for an interview with Bloomberg. And basically, he said, we're edging back to a more normalized rate of transactions. So translation to that is let's go.
Yeah. Trying to not manipulate public markets, like, we're fucking ready.
Yeah, exactly.
Let's just go back for a second, because Lowell Barron is sort of like the new ascendant wunderkind. Like, is Ben Brown he's running from the Columbia Street waterfront to Brookfield Place every day?
Well, there's Ben Brown, and then there's Connor Teskey, who's like way deep in the
I was
labyrinth.
confusing Connor Teskey and Lowell Barron. Teskey is like...
Connor's the guy. He's like Bruce Flatt's heir apparent. This is just the new Brian Kingston.
I know, but then Ben Brown, for a long time, was like the new Bruce Flatt.
He had juice?
He had massive juice.
It could be that he kind of somehow upset the robes, because Brookfield's alumni network basically controls the company.
They have that weird the partners thing that is like absolutely crime.
It's a freaking conclave. Yeah,
I mean it's like the most crazy setup ever, and I don't understand how anyone gets comfortable with the equity of.
Yeah, they practically invented related party transactions. But Lowell Barron, who basically succeeded Brian Kingston as the guy we would care about the most, he heads the CRE desk at Brookfield. So what jumped out at you from the interview?
I mean, honestly, it was the fact that they're just talking about this sales volume. Like, look, our increase, we did $13 billion this year. We did 3 the year before, 2 the year before. Like, how many of those? I think a bunch of them were sold to themselves. I think
that is correct. But that's the Brookfield way, as they say.
Yeah, of course.
There is one we just chopped it up on a week or so ago, and Starwood bought their triple net machine, Fundamental.
Yeah, Fundamental.
So
yeah, which, by the way, thank you for the great feedback, listeners.
Yeah, that was incredible. Listen, we really appreciate that. This guy came at us with like an incredibly nuanced critique of what we got wrong, which we love and appreciate.
The one thing I would say that Lowell said is, like, over the last several years, there's been a severe lack of liquidity in the market, and there haven't been larger transactions trading. Like, that's just not true. The only thing that's been trading are larger transactions.
Yeah, like Blackstone Air Communities happened, a year and change ago.
Yeah, Cortera, Lennar, like all the ones we've talked about. So it's just kind of funny. Like, again, we talk a lot about the media spinning the narrative.
But like, this is what they do, right? Like, this is the new thesis. Everyone's going to jump on this interview. Everyone did jump on it. These guys know that just by being in front of the press, they're generating news just by saying, hey, we're going to pick up the phone and talk to you.
What's interesting, I think, too, is that they raised $16 billion. I'd be interested to see the cadence of how previous fundraisers went, because Blackstone famously is like one close. Like, it's the most fucking gangster thing ever.
What do you mean? Like, in one, they'll just announce, oh yeah, we raised $30 billion for Brex or whatever it's called.
Done. Yeah.
Yeah. Boom.
Whereas other groups are like, we're out in the market. It's been 18 months. We're getting $80 million from Oregon teachers, like $35 million from South Carolina firefighters.
Yeah.
And
they'll dribble and drabble all those releases out, right?
Yeah. And especially now, there are a lot of hung fundraisers out there that have been year, 2 years.
Yeah, you've been talking about that, right? Like well below their targets, or just not able to raise at all. And then they're looking at strategic alternatives, M&A in some cases, right? Or selling themselves potentially.
Well, the problem, as we said before, is like, if you hire for a $10 billion fund and you only raise 5, like, that's really bad. And if there is no carry, you don't have a big enough asset base to service all your people, like, it's tough. So anyway, like, $6 billion is like a big close, that's a big close. But my question would be, I just was wondering, how long have they been in the market? And like previously, how long was like the previous 3 Brookfield vehicles in the market before they closed?
So So Barron made an interesting point about they also, like most other groups, had a lot of reluctance from LPs to kick in money. And the point that he's making is that part of it is like we weren't returning enough money to them. And now we've had these big exits and we've been able to kick money back to them, which has helped us raise the next gargantuan sum of money.
I mean, it's a great point. Like there hasn't been liquidity in VC, there hasn't been liquidity in PE, and it's been harder and harder to raise money.
We should set the scene with a stat. So institutional real estate collectively, globally, raised about $177 billion in 2024, which seems like a lot, but it's 30% below the 2021 peak. So these guys always have their sights on the next big thing. They were hoping to get in that much money. They're not able to, so they have to get creative.
The other thing I would say about Brookfield too, it's not like they're like, oh, we did 13 billion, like what great success. Like one, like how good were the returns? Two, they've been like giving back office buildings left and right across the country.
Maybe the singular theme of this podcast is, do returns matter?
No, like they obviously don't. I mean, they're binary, right?
We've talked about Carlyle. We've talked about many others.
They matter only insofar as they allow you to raise the next fund. That's the only thing that matters. Yeah. How high that is depends on like what firm you are.
Yeah, but he did make some other points about. He made a point about distress that I thought was interesting, which people have made before, which is like, hey, we're seeing the asset level distress, but we're not necessarily seeing that distress translate into action, which means a fire sale, a take back, etc. Now we're seeing some of that. So he was saying that distress was kind of taking its time, seeping through the system.
Wow. What a unique point that I've never heard from anybody ever before.
Have you ever heard it put as eloquently as the following? This moment in time continues to be elongated. That's what he said.
Is that William Carlos Williams running Brookfield Real Estate?
So much depends upon a red wheelbarrow.
Anyway, so it was a fun story, and then a related story would be what Blackstone's up to. So you mentioned you pinged me this morning, and you said Blackstone juicing up the media machine. So let's talk about it. What's going on?
Blackstone's like, the time is now. We got to strike while the iron's hot. Yeah. We're nearly at the tipping point. Like, we're going to be Flash Boys.
Reacceleration was their theme of 2024, I believe.
Yeah, maybe a little bit early. That's okay. But no, it's what we talked about with Cortland last week. Supply demand matters as much for asset allocators as it does like at the actual asset level. If there's not enough good stuff to buy, especially if you got to put out huge chunks of capital, that means the prices of those good assets are going to go up. And you're seeing that everywhere. Like stuff with a clean story is trading tight. There's not enough stuff that they can go to their LPs with straight face and say, this is good. We're going to pay up for this. We think this is, solid risk-adjusted returns. And even Lowell Barron says the same thing. He's like, oh yeah, we're only going after like the strongest sectors. Like, no shit, dude.
The best stuff. Yeah.
Sorry, I'm like cursing like a storm on this podcast, but
well, this is the promote podcast. You're okay.
Piss reeking shit stinking fuck.
But I think this is the thing, right? Like they're aware of their position in the industry. They basically are speaking not only for themselves, they're pretty aware they're setting the tone for the industry, and the media swallows it all up. They were talking about how their CRE portfolio has shrunk a little bit, Blackstone, but the story had the following. It said, still the largest portfolio on the planet. Like, there is a fetishization of the size of these guys.
At this point, like Blackstone and Brookfield are basically just like the Ford assembly line, like putting together the Model T.
You put it really nicely once you said like widgets of risk-adjusted returns.
Yeah, they're just making widgets, right? Like it's the ABC Supply Co. The media though gets more and more important with the channel that they're all trying to go to now.
Yes,
because obviously all these folks who are allocators, they're like, we're trying to be investors. Like, I'm going to write a white paper, or like, here's our house. Like anyone who says like, I have a house view, like this is our house view. Like those people, the media matters, but they're like, oh, we got to like come to this independent thought that everyone else has.
We're going to have our task force and figure this out.
Yeah. But when you're going to try to market to retail or through 401ks, like what matters are like who has the distribution and then like marketing itself to retail. And those groups, I mean...
And by distribution, you mean not only kind of mechanisms to raise capital, but also mechanisms to put the messaging out, right?
Yeah.
Which is why John Gray is like killing it on LinkedIn with Daniel. He sat down with the editor-in-chief of LinkedIn, Daniel Roth, and he talked about like the running videos, obviously, but it was more like it's a perfect way for him to stay in the mix with regular folk in a way.
This is not any different than like Timothée Chalamet going on College Game Day to promote A Complete Unknown. Like, it's the same thing. Like, John Grain, just look at me, like, runs every day, like, kind of a dad bod, just like me. Like, I should give Beaver Eat some money, you know? Like, that's what this is all about. It's like, you have to be everywhere all at once. You can't just show up as a talking head on CNBC anymore.
Zooming out, we've been talking a lot about tapping into these new pools of huge capital. We talked a couple pods ago about Greystar cozying up to RIAs, right? And we said, like, this is going to be, if they can pull it off, you're going to see a lot more people in this line of business where you're tapping into these pools of capital that have heretofore been not really used on by real estate.
Yeah, let me just say one thing too. Institutions, you know, if you raise $100 million from an institution and then $100 million from retail, the group that raises $100 million from retail, assuming the same performance, will be significantly wealthier than the group from the institution. The institutions are going to beat you up on fees. They're going to be incredibly annoying. They're going to require tons of back office.
Also, they have more juice to like litigate when shit goes down.
Oh, yeah. But think of it this way. Like, you can't run, you know, IR with like Deborah sending out a scanned PDF saying like, here's a picture of a unit we renovated. They're going to want a lot more than that.
And this is actually harkens back to something we talked about when we talked about Greenbrook and Carlisle. We talked about, like, you have to basically set up your organization to be able to cater and speak the language of these mega funds. Yeah, similar kind of thing here.
Totally. I don't think what people understand is there's these groups of companies that have done what are called DSTs, so Delaware Statutory Trusts. So basically, if you sell like a little office building and you don't want to go do a 1031 yourself and you don't think you can find a deal, you can send it to one of these companies like Pasco or Bonaventure, or there's a million of them, Capital Square, and they'll aggregate all those 1031s and buy like an overpriced multi-deal. And those guys have made so much money.
Yeah,
like I don't think you understand.
I do not. I mean, I think it's just the distribution is basically the 90% of the puzzle. You're saying.
The fee load is like unbelievable.
Yeah.
Like, it's so high. High promotes over like a 5. And huge upfront fees to account for like the legal and taxes, which is like not that much. And there are these groups that no one's ever heard of that have just been buying kind of like assets all over the place for 30 years, where the founders are worth like billions of dollars. The Pasco guys have like G6s.
So we talked with insurance about how like Apollo with Athene and KKR with Global Atlantic and Blackstone, most recently with Legal in General, they found a way they've basically tapped into new sources of originations for their bets, and private credit needs constant fuel, and insurance has become a big part of it. We've talked about all that. The more recent one is even more interesting and potentially an even bigger pool of capital. We're talking 401ks.
Company match, baby.
$12 trillion, Will. $12 trillion is crazy.
Yeah, company match. Oof. We're coming for Vanguard. We're coming for Schwab, Fidelity, all the ETFs, private assets. We're coming for you.
Yeah, so let's set the scene. So the Trump administration's been a lot more open, or has been making a big push to funnel retirement savings into private equity, and is trying to set the stage to make that a lot easier. And seeing the writing on the wall, a lot of these big money guys, so Blue Owl, Blackstone, KKR, Ares, have been setting up relationships with 401k managers. So when this happens, when this goes through, they're going to be able to tap that giant pool of capital to then fund private credit bets. And I'm assuming some of those will end up in real estate as well.
100%. I mean, I tell you what, like John Gray's next running video is going to be on State Street talking to, Wellington and State Street, being like,
it's funny you mentioned Wellington. The earnings call, he announced a product with Wellington that's ready to go.
I know but that's what I'm talking about distribution too. Because like those folks have Wellington has or State Street, all these global 401k providers have so much distribution into all these companies. It's like, if you're Blackstone, you deal with one API, and go do it. They do all your sales for you. I mean, I joked. I remember I was talking with someone a couple years ago. I was joking that like Blackstone should buy Edward Jones and just turn them into like Blackstone Sales University, and like that's kind of what they're doing, but like at the higher level, obviously, because if you're Blackstone, like IR for King Abdullah University is a lot different than IR for 401k providers. First of all, it's highly, highly regulated. Like if Blackstone's doing it, you got to be a custodian, you got to do all this.
Sure.
It's a way different business. So this is really smart because I'm sure that the fee load to the 401k providers is a lot higher than if they put it into a 5 BIP ETF for whatever.
Yeah, to that point, I'm going to read you a quote from the excellent Bloomberg article, which I'll put in the show notes. This is Raj. Oh, what a great name. I don't think you know what this means, but Ares's global head of wealth management is called Raj Dhanda. And Dhanda means business, which is perfect.
Wait, seriously? His name is Raj Business?
Yeah, the Dhanda means trade. It's incredible. So Mr. Raj says, he says the following. The prior directive was choose the lowest fee option. You don't always get the best value for the lowest price. They're setting this up. They're feeling
absolute
it right
nonsense. Like how many Blackstone vehicles over? First of all, like the IRR is made up because again, they're duration, right? But like over the long term, if you're retiring, don't give your money to Blue Owl mid-market private credit ops.
People have been sounding the alarm. There was a guy at something called the Consumer Federation of America who's like, the risks are giant in this thing. They're not very well understood. And are the masses really ready to fund, your Miami Tower or your Boca Raton retirement home? Who knows?
We talked about with Greystar pitching RIAs, how that makes a lot of sense because if you're a taxable investor, there are, with the tax law changes, a lot of real benefits to investing in private real estate that can help you outperform relative to other asset classes on a tax-adjusted basis. If you're investing in real estate out of a 401k where you don't pay taxes and you actually can't take advantage of the depreciation, like the fuck are you doing?
Empower, which is one of the 401k managers, I think in May they said they've already talked to Apollo, Franklin Templeton, which is the parent company of our Benefit Street Partners, and others to provide private equity, credit, and real estate in some accounts. So I wonder what this, like fully fleshed out when this is live or good to go, what the real estate product could look like.
It's got to be duration, right? That to me is the benefit of doing this out of a 401k or doing super high octane stuff that generates a ton of taxable income that you can avoid. So to me, like private credit, short duration private credit makes a lot of sense out of your 401k. Like if that's the way to do it, because again, you're not paying taxes on it, so you're getting the gross return. The other thing that makes sense is like going into something with building out what we're going to talk about later, like Aventura, out of your 401k, where you have a super long time horizon. You literally can't get the money without paying a fee. So doing something like that to me makes a lot of sense. Because if I'm Blackstone or if I'm one of these firms, what's great? A 20-year project where no one really knows if it's successful or not for 20 years, but you charge fees for 20 years.
Also called the EB5 way.
I mean, also that.
If they're able to tap into these pools of capital and become less and less reliant on institutional LPs, what the landscape's going to look like in a few years, it's going to be super interesting to track. Like $177 billion compared to the pools that are available now through insurance and RIAs and all of this, maybe not much money.
You always want to get in front of where the capital flows, and there's not much more capital that's flowing downhill than in boomer retirement accounts.
Overwhelmed by a massive bank accounts, most CRE players find tracking cash across banks and project LLCs to be a huge pain. Enter Vesto. With real-time balances, transactions, and cash flow monitoring, Vesto gives you a single, clear point of access for all those accounts. You can see every account balance and transaction in real time and save the headache of logging into each one. Now, Vesto's worked with over 100 CRE firms, and you can go to Vesto.com to see how they can help you. That's Vesto.com. And tell them the promote sent you.
I believe in America.
America has made my fortune.
And I don't think anyone believes in America any more than Donald Soffer, because where else could this type of life happen?
This is the most extraordinary American dream story, like for real. A man sees a swamp. He imagines something more. Teams up with his dad and a guy called Arthur G. Cohen.
Arthur G. Cohen has been like a tangential person in quite a lot of real estate stories.
He's one of those recurring characters who shows up like Johnny Ola. But anyway, so they're in the Miami MSA somewhere, and there's this massive collection of wetlands, and they decide to buy them, and they pay. The estimates vary because of conflicting news reports, but safe to say they paid between $5,500 and $7,500 an acre. $6 million for 785 acres.
Shockingly enough, Arthur Cohen did this twice. This is actually more expensive than what he paid for all the million square feet that he bought in Dumbo. with David
No fucking
Willentis.
way. Oh, he's one. Is he Willentis' guy? Oh my god.
Hmm.
That's my favorite trade of all time.
2 for 2.
Well done, Arthur. Anyway, so we've got our boy Don Soffer, and he buys this giant, absolutely astonishingly large land in the middle of the Miami MSA, and he remarks to his dad, "Hey, developing this thing will be an adventure." And I know you're not a Spanish speaker, Will, but what does adventure translate to?
Un poquito.
Well, how do you say adventure in Spanish?
Aventura.
Exactly. So we have this giant, massive land, and it's going to need a shit ton of work because obviously we're talking about swamp and environmental remediation, rezonings up the wazoo. It's going to be a very complicated thing. Fortunately, Don Soffer had a pretty good guy in his corner. What do we know about King Kirk?
Oof. All right. So Claude Kirk, he called it confrontation politics, which is just fantastic. And he also described himself as a, quote, tree-shaking son of a bitch. And
It's so good.
yeah, that's just, God, we used to be a country.
Yeah, for real. He once ordered his men to resist federal marshals, quote, with force. So King Claude doesn't sound like the best guy, but he sounds like the best guy to have in your corner. And what Don Soffer did, as many have done since, this is what Don Soffer said. He said, "We preyed on his boastfulness. He presented the plan for Aventura to the cabinet like it was his idea. And then we got all the permits we needed." That's a lot of permits. They built an astonishing 24,000 condos.
Oh my God.
Yeah.
So many condos.
And malls and God knows all kinds of mixed use.
Wait, how did they preserve all this open land, though?
God, do I know? Oh, of course I know, but why don't you tell them?
What has a lot of green space and fairways?
Preferably you can drive from one to the other.
He got land preserved for green space as a golf course.
You know, I've often thought of becoming a golf club.
Amazing. Absolutely amazing. It's just, I mean, that's a Hall of Fame move. It's kind of like, you know, when they used to put goats on, who did this? Trump did this a couple times.
Trump
as
did
well.
this, yeah.
Yeah, to call it farmland. But anyway, it's also the way that they were able to figure out the zoning and structure it in a way that he could, Don Soffer could basically become the master plan developer and sell off parcels to other developers, and at pretty fucking insane markup. So a couple of these parcels he was able to sell at $1 million an acre, which I'm still confused about. I don't quite trust.
Like, think about it. Like, you $1 million an acre and you spend $1 million on a house. Like, you're a pretty sick house for $2 million.
That's fair. So he was able to do that, and this Aventura obviously became the seat of the Turnberry Empire.
And the Soffer family is sort of like one of the notorious uber wealthy developer families up there with like
Tibber Hollow, that skyline shaping giant family.
Yeah, who's the Gil Deezer, like those guys?
No, not even close. Not even close, bro.
No, I would say they're more like a Lafrac or somebody like that.
Yes, exactly. They're like freaking oligarchy level in Miami.
They're up there. And so they've built this out, and you end up having like all the super high-end retail, like the Aventura Mall is like one of the best malls in the United States. All of these homes, which again, the key to a big master plan is you need the underlying value of the land to compound at a super high rate. And that's just...
And this was in the Miami MSA, like, wow, right?
Yeah, 100%. And so what's funny though is that this isn't the only like super successful massive thing that they built. You know, they have the Fontainebleau as well, famously.
We should talk a little bit about Don Soffer's life. The man lived.
Oh, did he ever?
To really capture the spirit of the man, you have to go board a little yacht called Monkey Business.
I mean, I think it's time to have our heart to heart.
So what happened here? Monkey Business was I think it was an 80-footer.
A little smaller than I would have thought.
And it became kind of the see and be seen destination for Hollywood and the hoi polloi basically of America. Elizabeth Taylor was on there. My boy Jack Nicholson showed up a couple times.
Lots of people were on there.
Oh, I could so see Don Soffer and Jack Nicholson getting tanked and like, yeah, Irish,
getting super tan together. Just phenomenal. So the best part about Monkey Business, in my view, is that you could rent it. Like Soffer, he was such a good time guy.
Capitalist.
That he's like, you know what? Like, everyone else should have this lifestyle. So busy guys could rent monkey business for themselves. And so why do we keep saying this word monkey business? Don Soffer took down a president.
A potential president, yeah.
Other candidates are afraid to rock the boat.
Unbelievable.
So one of my hot takes is that Gary Hart could see the future, and this is one of the most pivotal things that's happened in the history of the United States.
Okay.
Where if Gary Hart wins the presidency, we stay out of the Iraq War. He has 2 terms. He invests in the internet.
Oh boy.
It's one of my biggest hot takes.
So you're saying monkey business was like the sliding doors moment of American politics?
It's one of them, yeah. Bill Clinton never becomes president. So anyway, Gary Hart, was running for the 1988 Democratic presidential nomination. This picture came out of him with Donna Rice, who is one of Soffer's ladies. Donnie, what do they call him?
Donnie's girls.
Donnie's girls. I mean, what did Donnie say about that name?
Oh, he said that's just an expression used by jealous guys.
Sounds right. So this picture comes out with Donna Rice, who Gary Hart is not married to, sitting on his lap and not a little bit of a compromising position. And then I think he said afterwards...
And back in the day, that used to matter. Now it doesn't matter as much.
Unless you're the CEO of Astronomer.
Or unless you go to Coldplay concerts.
Yeah. So he then... I think he issued a challenge to the reporters. He's like, follow me. I have the most boring life in the world. You'll never find anything. I'm not cheating on my wife or whatever. And then they literally found him a week later, leaving a woman's apartment at 5 o'clock in the morning. And that was the end of his presidential campaign.
Right. So and then he did eventually, Soffer did put the yacht up for sale. And you know why he did?
He got a bigger one.
To the point you made earlier. Yeah, he got a bigger one.
We talked about Turnberry. So, but I think it's important that there was a big split in the family. There's a schism.
Always is when you have a family of this size and stature.
Yeah. So,
or often is.
So you had the daughters, Jackie, and I think that part of the family
Soffer,
took Turnberry.
Yeah.
And then Jeff Soffer, another man about town, took the Fontainebleau.
Jeff Soffer's been in the headlines for many things. Big developer, is able to wrangle a lot of money together for projects, but he's also in the popular press. He's known for 2 things. One, he was Mr. L. McPherson, so he's married to the body, which is anything you want to say about that?
Nope.
And then 2, he was the victim of a confidence scheme. There was a fake Saudi prince who was basically befriended Soffer, and they thought that, this was going to be an investor, I believe, in their projects and stuff.
He was going to buy 30% of the Fontainebleau for $450 million or something.
Correct. And you know how they found out that there was maybe something not kosher here?
How's that?
The man ordered prosciutto.
Oh boy. One of the best things about real estate is that if you have grit, determination, and you buy the right plot of land, you can manifest destiny yourself. And so this guy created not just a neighborhood, not just even really a town. He created
a freaking city,
the city and the whole lifestyle around it. When you think of the Aventura Mall, when you think of Aventura, when you think of the Fontainebleau, you think
Aventura
of these things,
has cultural resonance in that, almost like the Valley has in California. Aventura has there's an archetype of an Aventura lady, or
there absolutely is, and that is because of Donald Soffer. And monkey business aside, it's one of the most incredible things. Aventura is going to be here 100 years from now. And it's all thanks to this guy who paid $7,600 per acre, when there was nothing there but a swamp, and conned a governor into giving a lot of permits. And that's what's great about real estate is you can do magic. And Donald Soffer had the magic.
Don Soffer was one of the last cowboys, and he was a cowboy of a level that, would befit a John Ford film. That's how cool he was.
Well said.
That's it for the Promote podcast this week. A shout out again to our sponsor for this episode, Vesto. See how its service gives CRA players a single, clear point of access for all their bank accounts by going to vesto.com. That's vesto.com.
Share, subscribe, send to your friends.
I want some more reviews, guys. Let's go.
Send us constructive criticism to Hiten, not to me.
Tell us about Waltz.
If we got stuff wrong or you have a different take, let us know. We want to hear it. The engagement with all you guys is part of what makes this great.
When we drop a new pod, I know the next day we're going to get some spicy LinkedIn messages and emails. It really means a lot. And then, we get shouted out at the Toronto Open by a random Canadian dude. So those things really make it worth it. And also, we've said this before. We know you guys. Most of you just hang out with more people like you. They're all going to like this podcast. tell them about it. That was fun, man. I wish we can get into some monkey business together soon.
I'm married with a kid now.
So am I. All right. I'll talk to you next week, man.
See ya.
Ciao.